welcome back to the trading floor. I'm David Axtell. This is episode 12, the final episode in part 3, our series on forward contracts. And I'll be honest, when Luigi and I were planning this series, he said, "You have to do an episode on hedge accounting." I said, "Luigi, nobody wants to listen to an episode on hedge accounting." He said, "Exactly, that's why they need one." He was right, so here we are. Let me start with why this matters, because it's not obvious. You're a corporate treasurer. You've built a beautiful hedging program, graduated ratios, rolling forwards, disciplined execution. Your FX exposures are well managed. The board is happy. Then the quarterly results come out, and your CFO calls you. She's not happy because there's a $5 million loss on derivatives sitting in the income statement, and analysts are asking questions. What happened? Your hedges worked. The forward contracts did exactly what they were supposed to do. The loss on the forward was offset by a gain on the underlying exposure. Economically, you're flat, but the accounting rules recognized the hedge loss now and the exposure gain later. Different timing, and that timing mismatch created artificial earnings volatility. That's the problem hedge accounting solves. Without hedge accounting, derivative fair value changes flow straight through your income statement every quarter, up one quarter, down the next. Even though the underlying exposure moves in the opposite direction, but the exposure might not hit earnings until 3 months later when the sale is recognized or the payment settles. Hedge accounting aligns the timing. It says, this derivative is economically linked to this exposure. Let's recognize them together. So the gain on one and the loss on the other appear in the same period, largely offsetting each other. Earnings stay smooth. The CFO stays happy. The analysts don't ask uncomfortable questions. Simple concept, complex execution. There are two main accounting frameworks globally, ASC 815 under US GAAP and IFRS 9 under international standards. They achieve the same basic objective but differ in important ways. Both frameworks recognize 3 types of hedge accounting. Cash flow hedges. This is the most common for corporate FX hedging. You're hedging the variability of future cash flows, a forward contract protecting against Euro-US dollar movements on a forecasted Euro receivable. Under cash flow hedge accounting, the effective portion of the hedge gain or loss goes into other comprehensive income, OCI. It sits there, outside earnings, until the hedge transaction actually affects the income statement. Then it reclassifies from OCI to earnings at the same time as the exposure, timing aligned, volatility eliminated. Fair value hedges, less common for corporates, more relevant for financial institutions. You're hedging changes in the fair value of a recognized asset or liability. A forward hedging a Euro receivable already on your balance sheet. Both the hedge and the hedged item adjust through earnings simultaneously. The gains and losses largely offset, with only the small ineffective portion hitting the bottom line. Net investment hedges, used by multinationals hedging the translation effect of foreign subsidiaries. Both the translation adjustment and the hedge gain or loss flow through OCI. No earnings impact until you sell the subsidiary. Most corporates don't hedge this, as we discussed last episode, but for those that do, net investment hedge accounting keeps the noise out of earnings. Now, here's where it gets serious. Qualifying for hedge accounting is not automatic. You don't just execute a forward and tick a box. Both frameworks impose strict requirements, and if you fail them, the consequences are severe. Requirement 1. Documentation. Contemporaneous documentation at inception. Before you execute the hedge, you must have formal written documentation specifying the hedged item, the hedging instrument, the risk being hedged, and the method you'll use to assess effectiveness. Both ASC 815 and IFRS 9 prohibit retroactive designation. You cannot execute a forward on Monday and write the documentation on Friday. If the paperwork isn't done before the trade, you've permanently lost hedge accounting eligibility for that relationship. No exceptions, no appeals. I've seen companies lose hedge accounting qualification because someone was on holiday and the documentation didn't get completed before the trade went through. Real money, real consequences, a process failure, not a trading failure. This is why Fortune 500 companies have dedicated hedge accounting teams, people whose entire job is making sure the paperwork is right, on time, every time. Requirement 2, effectiveness testing. You must demonstrate that your hedge actually works, that the gains and losses on the derivative substantially offset the gains and losses on the exposure. And here's where the two frameworks diverge. ASC 815, the US standard, uses a bright line test, the dollar offset ratio. You calculate the cumulative change in the hedge's fair value divided by the cumulative change in the hedged item's fair value. That ratio must fall between 80 and 125% every quarter, no exceptions. If your ratio comes in at 79%, you fail. The entire hedge relationship is de-designated. All the gains or losses you've been accumulating in OCI, they get reclassified to earnings immediately in one quarter. That $5 million in OCI that was keeping your earnings smooth suddenly hits your income statement all at once. That's a cliff edge, and it's precisely the kind of earnings volatility your hedging program was designed to prevent. IFRS 9 took a different approach. It eliminated the 80 to 125% bright line. Instead, it uses a principles-based assessment. You must demonstrate three things. 1. An economic relationship exists between the hedge and the hedged item. They respond to the same risk factor. A Euro-US dollar forward and a Euro-US dollar receivable clearly have an economic relationship. 2. Credit risk doesn't dominate. The value changes in your hedge should be driven by the currency risk you're hedging, not by the creditworthiness of your bank counterparty. For an AA-rated bank, this is straightforward. 3. The hedge ratio is consistent with your risk management objectives. If your policy says hedge 100% of committed exposures and you're hedging 100%, you pass. The IFRS 9 approach is more flexible. A hedge that falls outside 80 to 125% can still qualify if the economic relationship holds and the ratio reflects genuine risk management intent. But that flexibility comes with a cost, more judgment required, more documentation, more audit scrutiny. IFRS 9 also introduced something genuinely useful: rebalancing. Under the old IAS 39 rules, if your hedge ratio got out of alignment, say your exposure grew from 100 million to 120 million, but your hedge was still at 100 million, you had to de-designate the entire relationship, recognize everything through earnings, then redesignate a new hedge at the updated amounts. Under IFRS 9, you can simply rebalance. Add 20 million to your existing hedge. Adjust the ratio back to 1-to-1. Continuous hedge accounting. No de-designation. No earnings disruption. For companies running rolling programs where exposures shift every quarter, this is a significant improvement. It reflects how hedging actually works in practice. Exposures change, hedges get adjusted. The accounting should accommodate that reality. Let me give you a practical example of how this plays out. A European retailer hedges £50 million of forecasted inventory purchases with a forward contract. Cash flow hedge designation, documented at inception. Effectiveness tested quarterly. Quarter 1. The forward has a fair value gain of $120,000. The exposure has an offsetting change of $115,000. Dollar offset ratio 104%, within the 80 to 125 range. Effective. 115,000 goes to OCI. The 5,000 of ineffectiveness goes straight to earnings. Small number, nobody notices. Quarter 2. Sterling moves sharply. The forward gain is now 300,000 cumulative. The exposure change is 280,000. Ratio 107%. Still within range. Still effective. 280,000 in OCI. 20,000 ineffectiveness to earnings. Quarter 3. Something changes. Maybe the retailer's purchasing patterns shift. Maybe they renegotiate terms. The exposure changes, but the hedge stays the same. The ratio comes in at 78% under ASC 815. Failure, de-designation. Everything in OCI gets reclassified to earnings this quarter. Under IFRS 9, the same company might rebalance and continue. Different standard, different outcome, same economic reality. There's a shortcut that saves enormous administrative effort. The critical terms match method. If the hedge and the hedged item have identical specifications, same currency pair, same notional amount, same settlement date, you can assert effectiveness qualitatively. No quarterly calculations needed. You simply confirm that the critical terms still match. A €10 million forward settling on the 15th of September, hedging a €10 million receivable due on the 15th of September qualifies for critical terms match. Same notional, same currency, same date. Effectiveness is assumed. But even small mismatches disqualify you. 10 million hedge for 9.8 million exposure. No match. 5-day date gap between hedge maturity and payment date? No match. Back to full quantitative testing every quarter. The practical implication? Structure your hedges to match your exposures precisely whenever possible. The accounting simplification is worth the operational effort. Let me finish with some honest perspective on all of this. Hedge accounting is the single biggest reason corporate hedging programs are more complex than they need to be. Companies choose forwards over options, partly because the accounting treatment is cleaner. They avoid exotic structures, not because they're economically inferior, but because the hedge accounting documentation is unworkable. They sometimes underhedge because the cost of maintaining hedge accounting qualification exceeds the cost of accepting some FX volatility. That's not how it should work. Accounting rules should reflect economic reality, not constrain it, but we operate in the world as it is, not as it should be. The good news is that IFRS 9 moved in the right direction. More principles, fewer bright lines, rebalancing instead of de-designation, alignment with risk management intent rather than arbitrary thresholds. If you're building or refining a hedging program, my advice is simple. Invest in the documentation process. Build it into your workflow from day one. Don't treat it as an afterthought. The companies that do hedge accounting well are the ones that have systematic processes, templates, checklists, calendar reminders, dedicated people. The companies that struggle are the ones where the trader executes the forward on Tuesday and someone in accounting finds out on Thursday and tries to backdate the documentation. That's how you lose qualification. That's how $5 million of OCI hits your earnings in one quarter. And that's how your CFO stops being happy. That wraps up part 3. Forwards. We've covered what they are, how they're priced, how corporations use them, and how the accounting works. 4 episodes, a complete picture. Next episode, we start part 4. FX swaps. The most traded instrument in currency markets. Over $3 trillion a day. More than spot. More than forwards, and yet most people outside the dealing room have never heard of them. I can't wait to explain why. This is The Trading Floor. I'm David Axtell. The book behind this series, FX Cash Products, by Luigi Rondinini and myself, covers hedge accounting frameworks in comprehensive detail, ASC 815, IFRS 9, worked examples, documentation templates, effectiveness testing methodologies, everything a treasury team needs, available through Rondinini Publishing. For professional tools including hedge documentation generators, effectiveness testing calculators, and compliance reporting templates, visit learn.rondinini.com. Production-ready Python implementations with full ASC 815 and IFRS 9 support. And if your organization needs consultancy on hedge accounting frameworks, policy design, or audit preparation, I work with clients through axtellconsulting.net. This is one of those areas where getting expert guidance early saves enormous pain later. See you in episode 13.